Hello students, today we are going to study about determinants of interest rates and the bond management strategies. So let's begin with it. So first is determinants of bond. So determinants of interest rates. So here we have, so nominal interest rate in the absence of inflation. So R is equal to R star plus IP plus DRP plus LP plus MRP. So R is a required return on debt security, that is bond we calculate, and R star is a real risk-free rate of interest. So the real risk-free rate of interest refers to the return available on a security with no risk of default. So in the case of debt securities, no default risk means that promised interest and principal payment are guaranteed to be made. And next is IP, that is inflation premium. This component of the risk-free rate of return is an inflation premium or a purchasing power loss premium. So investors require compensation for expected losses in purchasing power when they postpone current consumption and lend funds. So consequently, a premium for expected inflation is included in the required return on any security. Next is next is the DRP, that is default risk premium. So it is a major determinant of the general structure of interest rates, and it refers to the possibility of the failure to meet the terms of a loan agreement, of delay in payment, a total non-payment, of partial non-payment of interest and or principal amount. All financial assets except government securities are subject to some degree of default risk, although they differ in their degree of risk. So that is default risk premium for you. So in this, if there is any non-payment, total non-payment, partially non-payment of interest rates or even principal, that has to be taken for calculation. And the next is a liquidity premium. So it's talk about the liquidity in the market. Okay. And next is MRP, that is maturity risk premium. There is already maturity risk premium. It is interest rates. Okay. If interest rates rise, lenders may find themselves stuck with long-term loans paying the original rate prevailing at the time of the loan were made, whereas other lenders are able to make new loan at higher rates. So on the other hand, if interest rates go down, the same lenders will be pleased to find themselves receiving higher interest rate on their existing long-term loan than the rate at which other lender must make new loan. So these are the determinants of interest rates. Now let's learn about bond portfolio management strategies. So there are three types of bond management strategies. The first one is passive bond portfolio management, active bond portfolio management strategy, and the third one is match funding techniques. So let's see about the passive bond portfolio strategy. So passive strategy is less role expectation. So key inputs are known at the time of investment analysis. So key inputs such as objective of the investors, risk-taking ability, that's matter a lot when they are investing in bonds. So that is passively. The types of passive strategy, we have two: buy and hold strategy and indexing strategy. So first is buy and hold strategy. So it's a simple one. It involves buying a bond and holding it until the maturity. Purchase any bond, hold it till the maturity date. So managers select a portfolio of bonds based on the objective of the client. So whenever in investing, the manager always check for the objectives of the investors or a client with the intent of holding these bonds to maturity. So investors don't trade actively to maximize the return. So hold the bond with a maturity or duration which is close to their investment horizon. So you can adopt this strategy, or an investor can adopt this strategy. You can purchase such a bond which are closer to the horizon. So you can hold the bond uh, for maturity till the maturity, and you can earn money from it. Continuing to that, Examine factors such as quality rating, coupon level, terms to maturity, call features, etc. So only default free or very high quality securities should be held. So quality securities whose quality values are good, their ratings are good, so that can be held. So also those securities that are callable by firm, so allow where the issuer buy back the bond at particular price at particular time, that also can be holded. Or puttable by holders, allow bondholder to sell the bond to issuer at a specified price and time, should not be included. So these all not fall under the buy and holding strategy. Continuing to that, the buy and hold strategy minimize transaction cost because no need to frequently transacting on the bond, so the transaction cost can be reduced. Suitable for income maximizing investors with the low level of risk, who don't want to take much risk in the investment. Applicable for pensioners, endowment funds, bond mutual funds, and insurance companies. So these are all suitable for buy and hold strategy. So next is indexing strategy. So this is one of the important part element we can say of using the strategy. So the objective is to construct a portfolio of bonds that will equal the performance of a specified bond index. Okay, so here investment is done only in the bond of specific bond index. So where that bond is indexed. If you see Barclays Capital Aggregate Bond Index, Merrill Lynch Domestic Master, JP Morgan Government Bond Index, FTSE UK Gilts Index Series, JP Morgan Emerging Market Bond Index. So again, Merrill Lynch High Yield Master 2. So these are all indexes for bond. So performance is measured in terms of total return realized over the investment horizon of the particular index. Now coming to the advantage of indexing strategy. So poor and inconsistent performance of active bond managers could be avoided. That can be done. Lower transaction cost. So you are investing in indexing. Degree of control exercised by the investors. Now, factor affecting the selection of the index, two types. One is investors' risk tolerance and objective of the investment. If the objective of the investment is to reduce the risk and earn a steady income, that matters. Then if investors' risk tolerance, how much risk can be borne by the investor? If he is going through less risky, then again, he has to evaluate. He can ready to take a risk, then he can invest. Next is active management strategies. Now, after passive, this is active management strategies. So here, take advantage of market scenario which is prevailing in the economy. Requires major time-to-time adjustment or changes in portfolio. And the goal is to maximize total return, but at increased risk. So risk is very high here. Requires continuous analysis and observation on the part of portfolio manager because you have to invest in such securities actively. If you look at the types, we have interest rate anticipation, valuation analysis, credit analysis, yield spread analysis. Now, first one, that is interest rate anticipation. This is the riskiest strategy because the investor must act on uncertain forecast of future interest rates of the bonds. Okay, so might change, might go high, might go less. So it's very risky. When interest rates rise, bond price drop, and when interest rate drop, bond price rises. So that is vice versa. So increase the investment in long duration bonds when interest rates are expected to decline and vice versa. So that strategy can be applied. So the risk of misestimating interest moment is very high here. Now next is valuation analysis. So selecting the bond on the basis of the intrinsic value of the bond. So what are the factors which affect the bond's intrinsic value? So obviously bonds rating, call features, interest rates, etc. So buy the undervalued bond and sell the overvalued bonds because of this you can purchase at less and you can sell at high. If bond rating is higher, then interest is low, and as a result, income is also low. So that has to be given note while investing in the bond or putting in a strategy. Next comes is the credit analysis. It involves detailed analysis of the bond issuer to determine expected changes in its default risk. So here comes the all detailed analysis to the extent default risk, and they evaluate internal and external factor affect the credit rating of the company, such as financial ratios and inflation, etc. So here they evaluate all the factors which are affecting the rating of the company, especially credit rating. So higher the risk, higher the return. That is always be the main theme. Now next is yield spread analysis. Yield spread means difference between the return of two bonds. Okay, that will be evaluated. So factor of yield spread is business cycle and volatility in the market, interest rate. So business cycle depends which cycle the business particular is going through, and the volatility in the market interest rate, how much the changes happens because of the index change. And the third strategy is matched funding techniques. So we saw passive, we saw active. The third one is matched funding techniques. It is a mixture of passive buy and hold strategy and active management strategy. Okay, it's a mix of, it's a hybrid. So objective is to get higher return at minimum risk. So require constant monitoring, could give more return than buy and hold, but no, not higher than active management strategy. So here you get steady because you are, it's an hybrid buy and hold plus active management strategy. So could give more return than buy and hold, but not higher than active. It's in moderated one return the investor will get. So we have studied the uh, determinants of interest rates, and we have studied the uh, port bond management strategies. So thank you.